Hello everyone, welcome to ATM. This video is dedicated to gold. Everyone is talking about gold these days, and they have good reasons too. Gold hit an all-time high of $2,074 per ounce, or 55,500 rupees per 10 gram in August, which is a staggering 40% return this year alone. In the last 5 years, gold has returned around 120%, and in the last 10, it has returned around 170%. Now the question on our minds are, what really is driving gold higher? Is it going to continue rising? And how far can it really go? Well, to really understand the price of gold and appreciate its uniqueness, we first need to go a long way back in history and look at the key time frames when the metal played a significant role in facilitating trade and political maneuvers. Although it is believed that gold was discovered in Spanish caves in around 40,000 BC, it was the Egyptian goldsmiths who were the first to begin mining and smelting the metal in around 3600 BC as it began to be desired as a precious metal. It was later in 600 BC when gold was first used as currency in the form of coins by King Croesus of Lydia. In 1377, Great Britain was the first country to shift to a monetary system based on gold and silver. Around 400 years later, in 1792, the US moved to a bimetallic gold-silver currency standard through the Coinage Act. John Marshall, in 1848, found gold while building a sawmill near Sacramento, California, which triggered the famous California gold rush. In fact, 90% of all the gold ever mined was after this period. In 1929, the Great Depression hit the world economy, crashing the stock markets and triggering a steep 15% fall in global GDP over the next 3 years. This triggered a massive run on the banks, with everyone rushing to exchange their paper currency into physical gold, which significantly drained gold reserves to the extent that the banks were not being able to meet their commitment to convert currency to gold. As an emergency response to the crisis, then US President Franklin Roosevelt declared a national banking holiday in 1933 and subsequently passed a law making it a criminal offense to hold gold coins or certificates worth more than $100. In 1944, the Bretton Woods Agreement, formalized by the US Congress, was signed by all the 44 World War II allied nations. It was this agreement that made the US dollar the global currency of choice. It was decided that the US dollar will be pegged to gold at a fixed rate of $35 per ounce, while all other global currencies will be linked to the US dollar at fixed rates. The Allied nations agreed with this arrangement because the US at that time held nearly 75% of the world's total supply of gold. It was also at this time when the International Monetary Fund, the IMF, was set up to monitor and enforce the terms of the Bretton Woods Agreement. The World Bank was also set up to lend to European countries that were severely affected by World War II. In August of 1971, in a landmark development in the history of gold, then US President Richard Nixon announced that the US dollar will no longer be converted to gold, thereby officially ending the Bretton Woods Agreement and with it the gold standard. Since then, gold has been trading independently without any price controls. Let us now look at the unique properties of gold and the supply and demand metrics that make it the most sought after investment. Gold is durable, it is fungible, it's easily portable and divisible. It is not a gas and it does not dissolve in water. It is not radioactive and it does not rust, making it reliable to store forever. Gold cannot be replicated or duplicated. Well, theoretically it can, but it will take thousands of years to duplicate just 1 gram of gold, which just makes the effort worthless. Compared to other commodities such as crude oil, gold is not consumed in large scale, therefore its price is not affected by changes in supply and demand. In all, 190,000 tons of gold has been mined till date, and all of that gold is still above ground. To give some perspective, you can take all the gold ever mined and fill them in 3 Olympic-sized swimming pools. There is only around 3,000 tons of gold that is mined every year. At this rate, it will take more than 60 years to double the current quantity of gold. Compare this with 27,000 tons of silver being produced each year and the 18 million tons of copper that is produced annually. Mining of gold has become increasingly difficult due to the high costs involved, the political risks surrounding the location of the mines, and the high technical expertise that's required. On top of this, the unfavorable odds of just 1 in 1000 becoming a usable mine makes it a very tough activity. 12% of all the gold that was ever mined is sitting with the central banks around the world and the IMF as reserves. Although the US is officially listed as the number one country in terms of the amount of gold reserves with around 8,100 tons, some analysts believe that China, with their massive accumulation of gold in the past decade, might actually have more than 20,000 tons of the metal in reserves. Let us now look at the key factors that influence the price of gold and why I think gold prices will continue its uptrend. Number one is inflation. Let us look at the US dollar, for example. A quick look at this chart shows how the dollar has been steadily losing its value since 1913, which is when they first began tracking inflation data. The fall in value is steep, especially during crisis or major economic transformations. $100 in 1913, for example, is worth less than $2 today. Now compare this with gold that was pegged at around $20 in 1913 to where it is trading today. Inflation rate in India has also been rising rapidly. In the last 10 years, inflation rate has been rising by an average of 7.3% per annum, putting a big dent on the purchasing power of the rupee. To put this in perspective, 100 rupees in 2010 is worth only rupees 49 today, which is a 50% erosion of purchasing power. Rising inflation also results in real interest rates falling drastically. Let me explain how real interest rates are calculated. Real interest rate is nothing but the nominal interest rate adjusted for inflation. Many of us in India invest in fixed deposits or similar interest-bearing instruments because of the perceived comfort of capital protection despite low returns. However, with rising inflation coupled with falling interest rates, the real return on these investments are small or sometimes even negative. Let me explain with a simple example. Let's assume Mr. Kumar, who is a senior citizen, invests in an FD offered by his bank that quotes an interest rate of 6.6% for a 1-year term. Now, assuming the inflation rate in India this year is 7%, the actual or real interest rate that Mr. Kumar earns on his investment is negative 0.4%. Now, this is an example to show how money is losing value because of rising inflation. Of course, there are arguments about using retail versus wholesale inflation rates to calculate this number, but that is not the agenda for this video. Just remember that rising inflation rates hurt actual returns that we earn through interest-bearing instruments. Number two is the explosion of debt. As shown in this chart, total US debt has shot up to more than $26.5 trillion this year from $5.7 trillion in the year 2000, which is a 460% rise. In the last 10 years alone, US debt has risen by more than 200%. India's debt to GDP ratio was at 72% in financial year 2020, which seems good compared to an astounding 136% for the US. But with GDP taking a hit and debt rising significantly at the same time due to the COVID crisis, analysts expect India's debt to GDP to rise above 85% in financial year 2021. And that leads us to the third factor, which is the enormous amount of money that is printed to finance the debt. In a separate video, we will look at how money is created out of thin air, which is fascinating to dig into and understand. Now coming back to the money printing. This chart here clearly shows the significant rise in money printing in the US since 2007. In the last 3 months alone, the US Fed has printed more than $3 trillion to prop up the US economy from the COVID pandemic. Just to highlight the size, India's total GDP is only around $2 trillion. And finally, at number 4, is the general dissent or disapproval toward fiat currencies and the modern monetary system. Now, this is a key reason that has resulted in the creation of digital currencies such as Bitcoin, which has gained a lot of traction than anticipated as replacement to fiat currencies. In my opinion, gold has always been a great alternative and has had a vast history of being the global currency for centuries. It is not bound by political borders or agenda. It cannot be duplicated to infinity like fiat currencies. Gold has stood the test of time despite numerous currencies that have come and gone. It remains stable through recessions or high economic growth, inflationary or deflationary environments. It has proven its worth in terms of not just preservation of capital, but also has a great hedge against inflation. And it has great liquidity across the globe compared to many currencies in the world. I'm not suggesting that currencies such as the US dollar or the Indian rupee will collapse suddenly like those in Zimbabwe or Venezuela. However, we have seen proof of currencies losing their value over time. And we also do have to acknowledge that we live in an era of sensitive political environments such as the US-China trade war, border issues between India and China, and the resulting actions taken by India against Chinese products and businesses, Russia's differences with the US, which is still continuing since the Cold War era, and the call by European nations to replace the US dollar as the global reserve currency, to name a few, are all begging for a stable and reliable store of value, which in my opinion is gold. Historically, gold has outperformed the broader markets and other asset classes such as real estate in times of economic and political unrest. A quick comparison of gold prices versus the S&P 500 index clearly indicates this trend. Starting in 1971, after the gold US dollar link ended, when gold went from the low of the US government pegged value of $38 per ounce to as high as $1,500 in the next 10 years, versus a flat S&P 500 over that period. In 1987, during the financial crisis, gold outperformed the S&P 500. Some might remember or read about the Black Monday crash that resulted in a 22% fall in Dow Jones in a single session on 19th October of that year. And again, in the aftermath of the dot-com bubble, the September 11 attacks, Enron and WorldCom scandals, etc., gold did well compared to the S&P 500. And then the massive outperformance during the subprime crisis between 2008 and 2011 is clear to see. Gold did fall during 2008, but some economists believe that it was as a result of massive illiquidity in other asset classes that led people to sell gold to raise much needed cash. And finally, now amid the COVID-19 pandemic that has shaken the world, gold is proving yet again why it is the best store of value and inflation hedge by hitting all-time highs. Even Warren Buffett, who has historically had a very negative view on gold, has decided to invest $500 million into a gold mining company called Barrick Gold in August. Although some discount this to be a small investment for Berkshire Hathaway, I believe it is significant considering how averse Buffett was to investing in gold. In fact, Warren Buffett was once quoted as saying, "Gold gets dug out of the ground in Africa or someplace, then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head." I'd like to wrap up this video with a quote from the famous JP Morgan on gold that he made in the year 1912. "Gold is money. Everything else is credit." That is all for this video, folks. We will discuss about the best options available to invest in gold in a separate video. I'd like to end with a disclaimer that these are my personal opinion and are shared for educational purposes only and not intended to be financial advice. If you like the video, please hit the like button, subscribe to the channel, share the video with others, and do provide your feedback in the comments section. That will be the best motivation for me to keep creating videos with quality content. Thank you.